You say it's a good idea during uncertain times to hide in great balance sheets. So explain how investors can do that right now.
Brad, great to see you, and thanks for singing a little bit for us today. Certainly in times of uncertainty, the easiest place for us to hide as individual stock and bond pickers is great balance sheets. And why is that? If you have a company that has more cash than debt, you're not subject to the capital markets. You can operate your business, and you really don't have to worry about whether or not you have to pay off a certain bond that's coming due. So I think that's always been a great place to hide. Now, you probably won't get that on more of a passive investment level. You might have to shift over to more active management, which I'm always a big proponent of. But again, because active managers can kind of see through good balance sheets, they can see through to good fundamentals. And I think at this point, fundamentals is critically important in a market where we've seen technicals and momentum kind of just fall apart.
You know, in one of the notes this morning from Apollo chief economist Torsten Slok, he'd mentioned that tariffs have a negative effect and impact on corporate earnings as companies experience higher production costs. And so that factors into the balance sheet consideration for certain here. So what should investors be looking for as companies are not just making those announcements, but as they're looking through and combing through earnings reports, including those balance sheets, to really get a sense of how companies are adjusting for the impact of and the anticipated impact of any type of tariffs?
Thornton is absolutely right, because again, with all the tariff talk each day, each headline feels different. Each headline is creating more angst in the markets. And so you really have to know what you're investing in and what that company plans on doing. Because the company management, they're uncertain as well. So we spoke with over 10 companies last week, 10 CEOs last week, and we tried to get a flavor of, okay, how do you adjust for this headline, or how do you adjust for that? And so I think the key takeaway is that the really, really good companies and well-managed companies, they see over multiple decades, and their businesses are super stable. So they're not going to adjust every headline. And so again, if you look at companies' long-term margin structure and long-term return on capital over a very long period of time, they're going to be able to navigate through almost any environment. And those better companies, to us, are of value in this kind of market.
With that in mind, what do you think the theme that will play out as we're kind of previewing the next earnings season here? What do you think the core theme is to watch as we get into some of those earnings calls and hear from executives and management?
So, Brad, this is an excellent point to talk about, because the initial reaction, the gut reaction, is a rotation, right? We had a rotation from growth into value, a rotation from consumer discretionary into consumer staples. And with all these rotations, you just assume that the staples companies will do well, but food companies are under their own pressures today. And we're starting to see that as well. And we heard that from General Mills, for example, in their report that was just a week ago. So again, I think we need to go back to companies. So there's a company today that reported, I can't name the name, but they make natural gas facilities in the U.S., natural gas power plants. They did great. Their backlog increased by close to 80%. And so those are the companies we want to focus on. But again, that's not broad exposure. You really need to read into the details of each company, find the good management teams, find the good balance sheets, and those companies, hopefully through the next few quarters, will be much more stable than the broad market.
With that in mind, what is your kind of top idea as we enter into this next quarter?
Yeah, so I mean, a lot of the names that we have in the fund have gotten cheaper, and we like them a lot. So from a stability standpoint, one of the things that we've liked to see over time are water utilities, for example. Those companies traditionally traded at huge premiums relative to the S&P, relative to other utilities. But over the last few years, that multiple has contracted a lot. And so those names, again, in this area of the market where things look so unstable, their results should be pretty stable. We do like that area. Again, individual companies that are increasing their backlogs and that have good balance sheets where they don't need funding moving forward, we like that area as well. Some investment grade and higher yield bonds, again, going back to the balance sheet with more cash than debt, they're going to have the wherewithal to survive this environment. And again, you're going to get nice yields, 5, 6 to 7% yields. Those are all areas that we like today.
George, great to see you. Thanks so much for taking the time with us today.
Always appreciate seeing you, Brad. Thank you.